Are you still letting your high income completely lock you out of tax-free growth because you think you make too much money to fund a Roth account? If you don't fix your approach before the April 15th deadline hits, you're missing out on thousands of dollars in compounding returns this year alone, and that lost year never comes back. Most high earners trigger an unexpected tax bill when attempting a backdoor conversion because they completely mismanage the IRS aggregate accounting rules across every IRA, SEP, and simple account they own. That single paperwork mistake can quietly cost you more than $10,000 in taxes you never planned for when your CPA runs the pro rata numbers on Form 8606 in spring. Today, we are laying out the precise checklist to execute a clean backdoor Roth IRA conversion without triggering the pro rata rule on your tax return, step by step, with the deadlines that actually matter. We will break down IRS income limits, the aggregation trap, employer plan rollovers, and the exact moves to clear out your pre-tax balances before you file this year. By the end, you will know whether your conversion is actually clean, or whether you're one Form 8606 error away from a five-figure surprise on next year's return. You're watching Capital Blueprint, build wealth with clarity, not guesswork. This is educational content, not personal financial advice. Verify current IRS limits with a qualified professional before you act. If your modified adjusted gross income climbs past $161,000 as a single feeler, the IRS phases your direct Roth contribution all the way down to zero for that tax year, which is why six-figure earners keep hitting a wall at the brokerage login screen. High earners often confuse direct contributions with conversions. Direct funding has strict income limits, but Roth conversions have no magic cap whatsoever, so you can still build tax-free growth at any bracket if you follow the paperwork rules correctly. Executing a conversion sounds incredibly simple on paper, but if you hold any pre-tax money in a traditional SEP or simple IRA, the IRS views all your separate accounts as one giant bucket, and that mixing is what triggers the pro rata tax surprise. The hard deadline to clean up your pre-tax balances is December 31st of the calendar year you execute the conversion. Miss it, and your CPA will calculate a proportionate tax on the entire move when you file in April. Even a small, old rollover IRA from a previous employer can poison a six-figure backdoor conversion. So, pull your latest statements now and list every pre-tax balance before you move another dollar. When your income passes the threshold, the IRS starts phasing out your ability to make direct contributions over a narrow $15,000 window. That catches many six-figure earners off guard every single tax year, often mid-bonus season when Magi jumps. Leaving pre-tax money in any traditional SEP or simple IRA triggers the pro rata rule, which makes your conversion heavily taxable instead of clean and tax-free when your CPA files Form 8606, even if you only meant to move after-tax dollars. A single pro rata mistake on a backdoor conversion can tack more than $10,000 onto your tax bill, especially when pre-tax IRA dollars sit beside the after-tax amount you just moved and the IRS applies one blended ratio to the whole pot. Married couples filing jointly hit the same direct contribution wall at $240,000 of modified adjusted gross income, so both spouses need a conversion plan, not just the higher earner, or one partner's IRA can still trigger aggregation. Think of aggregation like mixing coffee into milk. Once pre-tax dollars are in the IRA bucket, you cannot pour out just the clean after-tax layer. The IRS taxes the blend, not your intention, when you convert to Roth. A backdoor conversion is a specific sequence where you make a non-deductible contribution to a traditional IRA and immediately roll it over into your Roth IRA, building tax-free growth without waiting for Congress to raise income limits again. This structural move offers high earners three core advantages that traditional pre-tax retirement accounts simply cannot match over long horizons, especially if you expect higher tax rates, state taxes, or RMD pressure in retirement. You can sidestep this hidden tax trap in three clear moves that isolate your pre-tax balances and keep your conversion clean before the IRS applies the aggregation formula. But each step has a timing rule you cannot skip. Not every employer plan accepts IRA rollovers, so confirm your 401k allows inbound transfers before you move a dime. Otherwise, your isolation strategy stalls, and you may need a different employer plan or solo 401k option. Speed matters between steps 2 and 3. Leaving after-tax cash sitting in a traditional IRA for weeks invites earnings that are partly taxable. Many advisors convert within days of the contribution posting to keep the basis clean. Your tactical funding window spans multiple months through April 15 for the prior tax year, but your balance clearing window must be finalized before midnight on December 31. 2 different clocks, and confusing them is an expensive mistake. To execute this without errors, cash must flow smoothly from your bank checking account through the non-deductible traditional account and rest permanently inside the Roth index funds you choose, with Form 8606 filed to document every hop. You must file IRS Form 86006 to report non-deductible contributions and conversions. Skip it, and the IRS has no record that your conversion basis was after-tax money, which invites audits, amended returns, and double taxation on the same dollars. Many investors fund the prior tax year through April 15 while clearing pre-tax balances by December 31st. Mixing those deadlines is one of the most expensive timing errors high earners make when they discover aggregation too late. If you also take the standard deduction, Form 8606 is still required for the conversion basis. Do not assume your tax software will catch a missing form when no Schedule A items are on your return. Ignoring your existing traditional balances creates an irreversible tax mistake, while rolling those balances into an active employer plan removes the risk and preserves your tax-free growth status on the conversion, but only if the plan accepts inbound rollovers. Consistently maximizing a $7,000 annual contribution at an 8% average market return over 20 years will build hundreds of thousands of dollars in completely tax-free wealth inside your Roth, wealth that never faces RMDs or future rate hikes. Waiting until you're already above the income limit means you missed years of tax-free compounding. You could have captured with a disciplined annual conversion, and each skipped year is gone forever, even if limits change later. If you already executed a messy conversion last year, you may need to amend prior returns, but fixing the structure before your next contribution is far cheaper than paying another $10,000 surprise bill when aggregation catches you twice. Here's the kicker most beginners miss. The backdoor Roth is legal and widely used, but it only stays clean when your IRA bucket is empty of pre-tax dollars on December 31st. Treat that date like a hard financial firewall. Review your current retirement accounts right now to confirm you don't have stray pre-tax balances lingering before you attempt your conversion this year. One old IRA is enough to trigger pro rata. Drop a comment below if you want our exact breakdown on how to properly file IRS Form 8606 to track your non-deductible contributions and keep your conversion audit ready.